there, business enthusiasts, and welcome back to another exciting episode on Legally Bound, Business and Real Estate Explained, where we break down the complex world of business law into bite-sized pieces. Today we're cracking the code on buyouts and comparing two heavy hitters in the game, asset purchases and stock purchases. So grab a cup of coffee, get comfy, and let's dive right in. If you're new here, don't forget to hit the subscribe button and the bell icon to stay updated with our latest content. Now let's get started. An asset purchase is when you're buying a company's assets, think physical property, inventory, patents, and customer lists, but not the business entity itself. The advantage? It allows you, the buyer, to handpick your assets and liabilities that you're willing to take on, so you can skip past potential skeletons in the company's closet that might come back later to haunt you. Moving on to stock purchases. Unlike asset purchases, you're here buying ownership interest in the whole company, warts and all. But that includes potential hidden liabilities that you have to be aware of. But hey, it's not all gloomy. Stock purchases can offer significant tax advantages and continuity in business relationships that can be vital for a company's operations. Now that we've covered the basics, let's see how these two methods stack up against each other. With an asset purchase, you're in the driver's seat, picking and choosing what you want. But here's where things get a little bit tricky, the tax implications. When you go for an asset purchase, the assets that you acquire will likely be revalued at the purchase price, which will step up their basis. While this can provide future depreciation benefits, it may also result in higher taxes on any subsequent sale of these assets due to the reduced capital gains benefit. Now let's switch gears to stock purchases. You're getting the whole package, the good and the bad. This can mean unanticipated liabilities. There's a silver lining. The tax implications can be more favorable, and the transition can be so much smoother, maintaining established business relationships and contracts. You see, in a stock purchase, the basis of the company's assets don't change for tax purposes. This means there's no immediate tax bill due on the increased value of those assets. However, the downside is that the company's assets continue to have their old depreciated basis, reducing your depreciation deductions for tax purposes moving forward. And there you have it, a decoded view of buyouts. Whether you're leaning towards an asset or a stock purchase, always remember every business and every deal is unique. It's important to engage with a legal and a financial advisor to ensure that your deal structure fits your situation. If you enjoyed this video and found it helpful, be sure to give it a thumbs up, share it with your fellow business enthusiasts, and also, don't forget to watch our video on 3 most common mistakes people make when buying a business in Virginia, and the link here below. Take care.
#blessed. They ain't ready for me. I'm a dangerous man with some money in my pocket. Keep up.